Hey, good afternoon, everyone. Marty Missouri here. Today is the 4th of June, 2025. This is your midweek snapshot. I'm going to start today with taking a look at our internal log. Been putting quite a few notes in here the last couple of days, and I want to share a bit of that with you. The first one here I just stuck in there, and that is the featured commentary from today's Institute for Supply Management's Services Survey for the month of May that was just released this morning. And I'll chart for you what the overall score was, but I wanted to touch base first on just the featured commentary. Every week the ISM will feature select commentaries from 10 of the industries that they survey. And I just wanted to kind of talk about really the topic of the year so far. Two of the topics, actually, one being trade and the other being the budget. So the first one here is from the construction industry, and just to highlight, tariff variability has thrown residential construction supply chains into chaos. From healthcare and social services, with regard to the budget, the federal budget cuts are affecting purchasing decisions. Now, remember, the point I keep making is that a federal budget deficit, which I'm not a huge fan of, by the way, nevertheless equates to a private sector surplus, right? There's just no way around that. Essentially what it says is the country is spending more, the government is spending more money into the economy, essentially, than it's pulling out by way of taxes. So everybody who doesn't like the idea of spending more than you got tends to rail against big budget deficits. And I sympathize, but I just want people to know that this economy more or less really survives or flourishes or grows, if you will, based on our system that we've evolved into on government deficit spending. So make no mistake, if indeed they were able to work on that from the spending side, you'd virtually have to feel it in the economy. Tariffs remain a challenge for the information sector. Due to the tariffs, we've had small price increases on our international raw materials, and some suppliers are holding back inventory to cover uncertainties. That's from mining. From life sciences, the impact of tariffs are being watched but are not driving changes in strategic plans. For retail trade, business is strong, but they think maybe that's some forward buying ahead of potentially rising tariffs. So they say consumer concerns over tariffs may be driving some demand. From transportation and warehousing, tariffs have increased the cost of doing business, but it's too early to tell what the lasting impact will be. We have tried to budget for the increase, but it has been a moving target. Overall, we see a leveling off of business activity. This from MRB Partners goes with populism. So government debt trends rarely impact bond market pricing and investor sentiment because they have historically, keyword there, historically been slow moving. Moreover, in recent decades, large budget deficits usually only occurred during recessions, where deflation concerns dominated and private credit demands were subdued. So folks, that takes you back all the way to the great John Maynard Keynes, and that is when the aggregate demand from the consumer declines. Essentially, it's time for the government to step in and do its best to fill the gap, and that tends to happen, of course, when you've got less revenue coming in, and now you ramp up spending. So therefore, you're going to run into deficits typically during recessions, but not during expansions. Expansions, business is growing, consumers doing better, they're spending money, and tax revenue is rising. You don't necessarily throw gasoline on that fire because you can be concerned about inflation. However, this decade has seen a true break in that pattern, as historically large deficits have persisted even during the economic expansion. COVID, of course, exacerbated things exponentially. And the fact that I'm going to say that we are now in what we'll call a populist regime, just really the relatively early stages, the response to COVID made sense, which was very different than the response to the Great Recession a dozen or so years earlier, where we were not yet in the new labor-friendly / populist regime, by my estimation. And therefore, the consumer got to feel a lot of pain. This time, the consumer wasn't going to be allowed to. Hence, the U.S. just absolutely carpet-bombed the economy with money, with liquidity. And current administration, as we'll explore, while there was some talk and some action, at least perceived, in the beginning of cutting the deficit, those days have quickly come to an end, and I'll talk about that in a second. In addition, most governments have been remarkably relaxed about the rising trend in government debt to GDP ratios, which is kind of what I'm just now saying, and ongoing huge budget deficits. Even the previously anti-deficit political parties have been either silent or ignored entirely. Again, staying on that theme, this is my commentary. The early in the year passion for getting the federal budget deficit and debt under control has done a remarkable 180. I say here, of course it did, as we've entered a new populist age, i.e. the big beautiful bill takes things notably in the other direction. It just continues to grow the deficit. I've been maintaining that markets are between a rock and a hard spot. For one, recession risk is not small here, which is not remotely priced into stocks. Clearly, the market does not see a downside economic risk. Now, let's say the market's getting the economy right. If so, it virtually has to be optimism over the new bill offsetting the angst and the reality of higher tariffs and thus keeping the economy in growth mode. So, for two, if recession is the rock, continued expansion, therefore, is the hard spot, as continued expansion, particularly via a further blowout of the budget deficit, read accelerating Treasury issuance, right? They're going to have to borrow to fund it, means there's no interest rate relief in sight, which ironically may ultimately be the straw that breaks the economy's back. In a nutshell, if we do contract economically, rates are going to fall like they are today on weaker jobs numbers from ADP. And then as things run their course and corporate profits decline accordingly and the markets decline accordingly, the equity market, then as we come out of it, then we'll be in a place to actually absorb, say, fiscal stimulus without initially at least ramping inflation to the moon. Okay, so there ultimately is a very attractive buying opportunity in equities during a recession, before it's over typically. But if we don't get that, if indeed we apply fiscal stimulus and actually increase these already large budget deficits enough to offset what I think will end up being kind of a 10% across the board tariff, well, you don't get that contraction and you don't get those rates going lower. In fact, you may get them going higher, and that's the making of a nearly 30% drop in stocks that occurred in 2022, which was a big decline outside of a recession. So this is just a tough spot as I continue to express and illustrate for you. And per the following from BCA, unsustainable public debt dynamics in the U.S. demand higher bond yields, which can push the economy into trouble, essentially what I just said. Net government debt in the U.S. will rise from 98% of GDP in 2024 to 149% in 2040 if just the 2017 tax cuts are going to be made permanent, which I suspect very much so that they are. This does not even include other measures in the bill that entail lower fiscal revenues. Such fiscal irresponsibility, those are BCA's words, will force bond vigilantes to act. That would be investors coming in and selling treasuries. Worryingly, the U.S. economy was already losing momentum absent the risks from the trade war or rising yields. U.S. stocks are not pricing in meaningful economic risks. I've been saying that over and over again. And the European profit outlook remains lackluster as well. I am more bullish still on other places in the world when it comes to equity markets. As for MRB, again, while they remain bullish on the economy, they do not see the recession risk that I and others like BCA see. But they do share our sentiment in terms of what that may mean for stocks. The investment backdrop will nevertheless remain challenging as risk asset, read equities, valuations will eventually be under downward pressure from higher developed market government bond yields. Although the U.S. tariff pivot has reduced the case for a recession, it has also ensured that developing market inflation stays sticky. That's essentially my point. If they're right and there's no recession looming, government bond yields, interest rates in the economy are going to go up as inflation remains sticky. The most likely outcomes are stagflation in the U.S. and some developed market economies, i.e. somewhat slower growth and sticky inflation. While a decent economic outlook is directionally supportive of equities or equity markets, the powerful price rebound since the tariff pivot has reduced future upside, especially for the still pricey U.S. market. I completely concur. Moreover, the threat of higher bond yields will ultimately be equity bearish. And again, I'm being very redundant right here. That's all the same thing that I keep saying from me and from a couple of sources. Okay, so I mentioned the ISM surveys. This is the net score, the headline scoring for the yellow is services, the white is manufacturing. Anything below 50 says that the sector is actually contracting, as in receding, as in recession. And you can see that typically you don't get them both there without being in a red shaded area, right, which is a recession. After the brief recession or the mild recession in 2002, which was a disaster for stocks, we did dip down just briefly here in 2003 before rising, and we had a pretty good time as investors between the two bubble bursts, right? And then rolled over, boom, we're in recession. Manufacturing showed some weakness in here. Our PWA index got close to the recession line, but it didn't quite get there here and here. Here it did. Here we actually got there in 2019. Then we had our COVID recession. And remember, 2023 was the one that everybody anticipated, including us, that never happened. Well, you can't really blame people for expecting it because here's two indicators that were in the red line that typically occur only during recessions, right, with rare exceptions. But of course, this time has to be different because we threw $11 trillion at everything in the U.S. So you're going to get lots of distortion as that is unwound. So we had another brief visit to the below 50 line in the middle of 2024, and here we're now approaching that again. So there's lots in the survey, but probably nothing more important than the new orders data, right? So now you can see here new orders have plunged notably below 50 for services, coming back a little bit for manufacturing, but still at a very, very low line historically. Notice we've never had both of them here, at least not in the last 20-some years, without being in recession. And we're there now, but there's lots of things that have happened in the last couple of years that tend not to happen without being in recession. So we have to be humble and say that, no, the recession call needs to be there, or it needs to be a concern, and we need to allocate for it in our portfolio. Nothing says that it has to happen, particularly if we get, a big spending bill, hitting the economy, later in the year. Okay, so as for the technicals, I've taken so much time, and that could be quick, and I just did these a couple days ago, and not a lot's changed. The S&P 500 daily chart, we have a very classic rising wedge pattern, and we have bearish momentum divergences. Folks, we've done this for years together, and you tend to get some weakness coming off of these reads, particularly when you're just coming off of overbought territory. Same thing, if not more so, for the NASDAQ 100 ETF, right? That is a rising wedge pattern if I ever saw one, and those are negative divergences in momentum. And we're just about back to all-time highs, so we'll see. Probably lots of resistance there. It wouldn't surprise me if we get there. It would come on probably, positive news or announcements or conversations with foreign leaders around tariffs and trade. Dollar continues to wane. Listen to a very interesting debate among some top economists earlier today on where the dollar is going, and they were kind of 50-50 split between it's about to start rising. One of the currency experts said the technical says that it will, and we should go on that. Others say that no, the momentum is to the downside, and it's probably going to continue. The bulls for the dollar, that at least the ones I listened to this morning, believe that a recession is likely this year, believe it or not, and that almost always the dollar will rally during recession because the uncertainty pulls capital into the U.S. Treasury market, from other currencies and so forth. The dollar is the safe haven, so to speak, and they think the dollar is going to go higher. Those who resist that say that the dollar will probably correlate more to falling bond yields, and currencies will be looking to pick up, more attractive, cheaper valuations abroad. And we've seen some of that this year already. In the short term, it wouldn't surprise me to see a pop in the dollar. I think technically it makes some sense to me. I think longer term that the dollar is going to go down on a longer term trend basis. And by the way, that's the consensus even among the economists who I just listened to. They were only debating the next few weeks and months in terms of where it's going. And again, we spend lots of time on currencies, so I'll probably be doing presentations in the not too distant future where we spend most of the time on what's going on with the dollar and other currencies. And then yields, this bull flag pattern, and this is the yield. This would suggest interest rates technically have some oomph to the upside. But frankly, I did extend it, but it's not really looking like a bull flag to me. This is too big of a flag itself relative to the flagpole, and it's retraced more than 50% of the rally here. So again, particularly if we get weak data on Friday, the ADP jobs number, the payroll number today, was weaker than expected, and we got a big rally in bonds. That's the yield falling, so that means prices were rising. We did really well on our long-term bond exposure today. In terms of how it looks technically, no real divergences, definitely a sell signal there. I would probably lean toward yields going lower, but a lot depends. If we get a strong jobs number on Friday, yields will spike higher, I think, in the absence of any other information. And then lastly, good old gold, really hanging in there. I'm a little bit surprised, to be honest with you, at least technically speaking. This is a very bearish near-term chart for gold, and it still just keeps finding its way back into this rising wedge pattern. We'll see. So gold reacted positively today to lower interest rates and a lower dollar, so those normal correlations are kind of coming back. It's reacted much of this rally to geopolitical angst, right? So let's say we got a truce in Russia and Ukraine. Let's say we had positive talks with Iran and so forth. The premium for geopolitical risk is going to go away. But if the economy is tanking and yields are coming down and the dollar is falling, well, then that could provide some real support and mitigate what it could be, well into a double-digit correction. So gold's kind of in an ambiguous spot for me, for lack of a better term. I still would lean bearish in the short run, very, very bullish in the long run, but because we're bearish in the short run, we've added a hedge to our gold position to protect us from something too meaningful to the downside. So folks, I am going to stop my rambling right there. Hope that was helpful and informational for you. And I'll be back later in the week or over the weekend. Have a good one. Take care. Bye-bye.